A single controversial policy move just wiped out over $1.7 trillion of market value in a matter of days. In a scene that few expected, President Trump was caught in a state of panic as global markets spiraled downward. Even tech giant Elon Musk couldn't hide his disbelief as investors worldwide braced for impact. Today, we break down the dramatic collision of high-stakes tariffs, investor anxiety, and a market left scrambling for stability. Stay tuned as we uncover the twists behind this unprecedented downturn. When President Trump unveiled his aggressive tariff strategy aimed at revitalizing American industry, he promised a return to the nation's economic glory days. The plan was clear: protect domestic jobs, boost manufacturing, and reclaim a lost era of prosperity. However, as the policy was rolled out, the anticipated boost soon gave way to widespread uncertainty. Within hours, markets reacted sharply. The intended revival was quickly overshadowed by a wave of retaliatory tariffs from Canada, Mexico, China, and even hints of further measures. The American consumer, along with seasoned investors, was suddenly facing unforeseen price hikes and a cascading effect that rattled more than 100 major indices. By mid-morning, despite a modest recovery on the Nasdaq of nearly 0.5%, the tremors across Wall Street were impossible to ignore. A stunning $1.7 trillion evaporated from the American stock market over a few trading sessions, a fall that experts compared to some of the worst days in recent memory. The impact was most visible in the tech sector. Tesla, often seen as a bellwether for modern industry, saw its market cap shrink by an astonishing $125 billion in a single day. Tech titans like Apple, Microsoft, Alphabet, Amazon, Nvidia, and Meta also recorded losses between 2% and 5%. The robust bullish trends of previous months now appeared to be nothing more than a fragile bubble on the verge of collapse. Simultaneously, indices such as the Dow Jones and the S&P 500 contributed to the overall decline. The Dow dropped nearly 900 points, while the S&P 500 tumbled by roughly 2.7% in just hours, rekindling memories of past market crashes and intensifying fears of a looming recession. While some financial experts viewed this upheaval as a painful yet temporary correction, others warned that the aggressive tariff policy could be a double-edged sword. Every major change comes with a transitional period, noted one seasoned market analyst, suggesting that the current volatility might eventually give way to a stronger economy. Yet, dissenting voices cautioned that the unpredictable nature of these policies could lead to deeper, longer-lasting impacts. Debates raged over whether the tariffs would ultimately force other nations to negotiate fairer trade deals for the United States, or if they would simply plunge the market into a full-blown recession. Investors found themselves at a crossroads. While a portion of the market braced for a short-term downturn, others saw the potential for a robust recovery if the administration's high-risk strategy paid off. Some strategists pointed to the potential for a hard landing if corporate earnings continued to falter and government interventions failed to restore confidence. In contrast, defenders of the tariff strategy insisted that short-term discomfort was a necessary cost for the promise of long-term economic strength. The shockwaves from America's tariff decisions extended far beyond its borders. Global markets were not immune to the fallout. In Canada, the main stock index stumbled significantly, mirroring the tremors felt in the US. Meanwhile, across the Atlantic, European indices and the Wall Street Dollar Index were pushed to their lowest levels in recent memory, reflecting a deep-seated uncertainty about the future. In Asia, Chinese stocks began to fall as economic data signaled a broader slowdown. Recent reports suggested that consumer prices in China were dropping more sharply than expected, a harbinger of the potential for a global deflationary trend. The interconnected nature of today's economy meant that every tariff and countermeasure had ramifications around the world. Amid these international tremors, trade negotiations resumed with a sense of urgency. Talks to update agreements like the North American Trade Pact, which Trump had once described as the fairest and most balanced deal ever enacted, were back on the agenda. High-level discussions among Canadian officials, U.S. trade representatives, and regional leaders underscored the need to rebuild trust and find a middle ground that would soothe market fears while safeguarding national interests. Central to this crisis was the Trump administration's steadfast use of tariffs as a diplomatic lever. Initially touted as a means to pressure other nations into fairer trading terms, the tariffs soon revealed a darker side. Measures targeting steel and aluminum aimed at bolstering domestic industries unwittingly disrupted critical supply chains. Manufacturers dependent on these imports were suddenly hit with soaring costs, forcing many to lower their profit forecasts dramatically. For instance, Delta Airlines revised its quarterly earnings outlook amid rising operational costs spurred by the new tariffs. The shock spread like wildfire. As companies struggled to adapt, investor confidence took another severe hit. Critics argued that by destabilizing not only the U.S., but also its international trade partners, the administration was inadvertently sabotaging its own economic recovery plans. Yet, defenders of the policy maintained that the turbulence was a temporary setback. They argued that the current market volatility was part of a necessary adjustment phase on inevitable cost on the path to achieving a more self-reliant American economy. As market oscillations continued, the debate over whether these measures would lead to lasting benefits or irreversible damage intensified. While the U.S. grappled with its internal market crisis, the international community was mobilizing its response. European nations quickly enacted retaliatory measures. In one striking move, the European Union imposed a steep 50% import duty on American whiskey, motorcycles, and motor boats, a bold statement against what they saw as unilateral economic aggression. Mexico, too, joined the fray. Trade officials there cautiously signaled their readiness to renegotiate terms with the U.S., suggesting adjustments such as aligning their tariff rates on Chinese goods with those of America. Meanwhile, Canadian policymakers, reeling from the initial shock, expressed a willingness to enter negotiations provided the U.S. demonstrated a genuine commitment to equitable trade practices. These international actions highlighted the delicate balance of modern global economics. No nation exists in isolation. Every shift in policy reverberates across borders. As countries reassessed their own economic vulnerabilities, the stage was set for a complex and risky diplomatic dance zone that could either stabilize global markets or plunge them into deeper uncertainty. As the dust settles on this dramatic market shakeup, the future remains shrouded in uncertainty. Key factors that will influence the coming months include crucial inflation reports, decisions by the Federal Reserve on interest rates, and potential government interventions aimed at restoring stability. Each element represents a piece of a larger economic puzzle that experts are still trying to solve. Investor focus has now shifted to the labor market, which, despite its current stability, faces potential headwinds. If corporate earnings continue to disappoint, or if consumer spending slows further, there is a genuine concern that job losses could escalate a development that would only intensify market anxiety. The political arena is equally volatile. As negotiations to update trade deals like the USMCA intensify, the administration's every move is under close scrutiny. President Trump's earlier claims that this tariff strategy was essential to bring wealth back to America now hang in the balance, subject to the ever-changing dynamics of global trade and investor sentiment. Every new twist in these negotiations forces market watchers to reconsider their strategies, with many wondering if the promise of long-term economic revival justifies the immediate upheaval. The pressing question remains: will the economy rebound, or are these signs the prelude to a full-scale recession? Before we close, pause for a moment to think about the decisions you might make if you were in the midst of this financial storm. Would you remain invested, trusting that the market's natural cycles would eventually restore balance? Or would you rethink your strategy and brace for more turbulence? We invite you to share your thoughts and experiences in the comments below. What do you believe will be the next big move in the global economy? Is the Trump administration's high-stakes approach a necessary catalyst for change? Or is it setting the stage for long-term financial instability? Your perspective matters, and we want to hear from you. Thank you for watching, and remember, knowledge isn't just power, it's your best defense in times of financial upheaval.